Alrighty, happy Sunday, everyone. Hope you guys are doing well. All right, we should be live. Make sure the audio is good. Alrighty, we're good to go. All right, guys, hope we're having a good weekend. I know I'm putting in the work this weekend with yesterday's free webinar masterclass. Back at it today for weekly prep. Right, trading financial freedom is well worth it, but it's definitely not easy. So with that, let's go ahead and get down to the business today. I have quite a few things to attend to here this Sunday, so going to look to keep this one here short and sweet. Appreciate you guys joining us and looking forward to getting down to it. If there's any questions at the end, I will do what I can to touch on them. But again, don't plan to be here for very long today. Just want to get to the business, get you guys what you need, and keep it moving here this Sunday. All right, so let's go ahead and get right to it. Hope we're doing well. Hope we're able to rest, relax, take it easy here ahead of the new week. So let me get the chat up. Hello, Cleo. Unicorn Queen, good day. Joe, good day, brother. Hope you're doing good. Reaper, here's my favorite trader. Really appreciate that, Reaper. Appreciate you joining us. All right, so let's get down to it. Weekly forecast for October 20th, 2024. So this week's economic calendar, we only have red folder high impact news on Thursday. And then we see the other days we have medium impact news. So I want to share some things with regard to where we're at with regard to the US election as well, which is going to be highly influential over the price action. So one thing I want to emphasize is that we have the election not the week that's coming, but the week after. So in about 2.5 weeks, we have the presidential elections, which are going to be, again, highly influential over the price action that we're seeing delivered to us. So it is a possibility that we could see cleaner price action on the other side of the elections, which is what I'm favoring, much larger ranges, larger expansions. And again, while the market's still uncertain, we can see more difficult price action. However, difficult price action does not mean impossible price action to find opportunities in. If you guys learned what it was I was teaching you guys yesterday, you have fresh supply of setups every single day, almost every single session, right? Because if you have been watching charts for any length of time, you know the market runs the highs and lows, and now you know it does it on a scheduled delivery that we can absolutely predict, right? So as long as you know that, you have a skill set that produces fresh income every single week, regardless of the market conditions. Even, for example, Friday, a nasty consolidation profile. You're still able to go in and harvest your income if you know what you're looking for, right? So just to say it's likely to be more difficult, but again, not impossible. And especially if you're learning even just from the free resources that myself and my team are making available. So in my mind, the best day is likely going to be Wednesday going into Thursday, considering the high impact news, and then going into Friday. And of course, the economic calendar will be more discussed in more detail in our weekly look ahead letter, which is our newsletter that we send out every Sunday about what every trader needs to know going into the new week. So the assets we're going to be looking at today, usual business, dollar, treasuries, and NASDAQ. Again, as always, we're going to confirm everything we look at within the context of intermarket analysis, right? For dollar, for bonds, and then also for the equity markets or the stock market. So looking at the US dollar weekly chart, the market has repriced to the weekly fair value gap. We have anticipated. And now that we have reached this key premium level, I will see how we trade here to confirm if we continue bullish, right? So the way my style is, the way I look at the market is I take it candle by candle, data point by data point, right? So on the weekly chart, a data point is a candlestick. On a 1 minute intraday time frame, each minute candle is giving new information, right? So what I do is I'm taking it day by day, right? Because I essentially don't get paid for my predictions 3 weeks, 3 months into the future. I get paid on what I'm looking at that week, that session, that day. So I tend to not dilute my focus with, okay, what's this thing going to do 2 months from now? That's not affecting my bottom line. So what I do focus on is what's the market going to do for that week, right? And then looking back, we were calling the market higher to this weekly imbalance all the way after we saw this candle here. So from this candle forward, calling dollar higher into the weekly imbalance. So now that we trade there, I want to get the information that the market's going to give me now that we've reached those levels, right? So do we continue to trade to it, through it, use it as support, right? Those are all things that I will be looking at and monitoring going into this week. This inversion fair value gap here, again, we called that real time, expecting it to use it to support, expand higher. Couldn't even touch it. It looks like it does, like it got close, but it actually did not touch that level, which further confirms bullishness and strength, right? So the market absolutely ripping higher into the premium targets we're given, and no one's calling dollar like this. So I'll continue to see again how we trade there to continue, see if we continue bullish rather. And then one thing I want to take your attention to is a key level is the weekly fair value gap below market price should support the market if bullish, right? So it's reasonable to see a retracement because we've already seen a lot of expansion higher. So where can it retrace to? The weekly fair value gap here. And then if we do trade into that, then I would want to see the market find support there and continue to expand higher if we remain bullish. However, like I said, I take in information day by day, week by week. What happens if we open and just smash through that weekly fair value gap? Well, then that's indicating something entirely different, and maybe I need to start looking for lower prices based off the information that I'm getting at that time. So what that allows me to do is be flexible and pivot as the market's giving me new information so that I'm not settled, locked in on one bias, and especially in the climate we're in, of course, things can change on a dime. Tyler, what's going on, brother? Appreciate you joining me, my man. Alrighty, daily time frame. So the market has reached all the premium targets from last week with no down close candles. So it is reasonable for the market to retrace before setting up the next leg higher. And then again, extremely bullish institutional order flow. And again, I'm not just saying it's extremely bullish after we saw all these up close candles. We did predict all this. And I was saying institutional order flow was bullish before we saw this price action here. So I don't want you guys to think maybe you didn't watch the past few streams. So I don't want you to think it's after the fact, like, yeah, no shit, it's bullish, right? We've already repriced up thousands of pips, but no, that was anticipated down here with all the work we covered in the institutional order flow entry drill, the inversion fair value gap, and then how the market's gravitating higher to these premium levels. So the swing high here on the daily time frame, that's where the fund level stops are, the buy stops on the fund level, and the market's just nicely careening on into those levels. And then we had that daily fair value gap. That's all going to be in last week's weekly outlook or in the PDF that you get if you're in the community. And then you see we repriced up into the high of that daily fair value gap. Just a really nice delivery. And then we see little to no down close candles in this price action, which is indicating the market's extremely bullish and it's in a hurry to get into those highs. And then some things you may want to study, you may want to investigate so that you can predict this the next time is study the signatures it was giving you here, right? Why did the market trade like this? We'll study the imbalances. Were we able to fill them in rather? Were we able to close in and get below 50% of these gaps? Absolutely not. So what that's doing is it's revealing to you, it's tipping its hand that the market is extremely bullish. Keep looking for higher prices. So again, now that we've seen all this bullishness, again, no down close candles in this entire run higher. So now that we've reached these premium levels, it's reasonable to see it retrace, do a short-term discount key level. This mitigation block in here, you can extend that through, and then we'll potentially look for new reaccumulation to take place in here for the next leg higher. So that's just understanding market maker buy models, understanding where the accumulation is going to take place based off where the distribution took place on the sell side of the curve. All right, 4-hour chart. I know we've had this arrow here on the chart for about 2 weeks now, calling for a blast off from the fair value gap, again into the buy side liquidity. So the 4-hour market maker buy model has been completed, right? The original consolidation here absolutely smoked. So now that we've expanded from the 4-hour fair value gap into our targets, again, a retracement is to be expected because we've already expanded higher. Can this thing just keep ripping? Anything's possible in this climate, absolutely. However, it's reasonable to also see the market retrace considering that we've already reached several key levels in here. And I already taught you guys or hinted at you guys how you can use the sell side of the curve to predict where they're likely going to reaccumulate and keep expanding higher. And just a really nice delivery here. All right, so going into bonds, treasuries, we have the weekly inversion fair value gap, which I have highlighted here in yellow color. So again, that weekly fair value gap or inversion fair value gap is holding price below it, meaning that we've got down below it, trading up into it, using it as resistance like we wanted to see last week. So for institutional order flow to remain bearish, seeing treasury sell off from the premium fair value gap would confirm it, right? So I just want to see us stay heavy inside the weekly inversion fair value gap, continue accelerating, and what will that allow me to trust? Higher prices on dollar, right? So again, if I'm bullish on dollar, I want to see treasury selling off, which we are seeing, which again is a confirmation tool that allows me to trust what I'm looking at in the US dollar. Again, seeing things that aren't in the chart. Daily time frame, again, treasuries remain bearish, supporting the risk off sentiment in dollar, right? Risk off just means dollars trading higher. Investors are not looking to take investments and put capital into risk assets. And essentially they're looking to put them into more safe haven assets, gold, US dollar, and just more safer assets from the perception of investors. So again, daily chart still remaining heavy, looking for discount targets. And again, that's going to continue to support higher US dollar. All right, moving right along into the NASDAQ. So NQ, the market is traded to and through the premium fair value gap that we had as a target, closing above consequent encroachment, right? So we had this weekly imbalance here. That's been the draw for the past 3 weeks. And with the way it's been delivering, yes, we've been seeing open, low, high close, up close candles, right? Candles that are expanding higher, but the delivery hasn't been great. There's been a lot of back and forth, but nonetheless, gravitating higher, expanding higher to our premium targets. So now that we've traded to this weekly fair value gap, if you guys remember what I was sharing last week, I'll have to see how we trade here, meaning, do we close above 50%? Yes. Now, are we able to use it as support and keep expanding higher? If we do continue to expand higher, again, the same targets as last week, we have the rejection block here, which is the highest body. And then through that, we have 50% of this wick, which is the premium wick consequent encroachment, right? So those are levels that I'll be looking for on the upside. If we get above the weekly fair value gap, use it as support and continue to expand higher. So again, I will measure if we can get above the weekly fair value gap, because then that'll determine whether or not the market can expand to all-time highs, which would be this high here, call that 21,200. So what'll tell me whether or not we get up to all-time highs will be how we trade at these key levels along the way. Julio, my man, how you doing? Do you think it's worth segmenting that weekly order block? Are you referring to the bearish order block here, like the up close candle, or the down close candles here as a bullish order block? And then once you get that in there, I'll come back to your question once I get through the analysis. All right, so daily chart. So consecutive bullish weeks in an election year has me avoiding calling a top in this market. So because order flow remains bullish, I want to stay in line with the underlying direction, right? So I want to stay looking for higher prices because, again, order flow is bullish. It's an election year. There's a lot at stake this year, and there's a lot of manipulation and rigging going on in the markets. Not that it always isn't, but especially this year, they like to artificially, or especially in election years rather, they like to artificially inflate the market, which gives people, again, the perception that the economy is doing really well, the presidents are doing really well, whatever it is that they're trying to sell to the public. So with that in mind, we use that insight to not look to call it top. I'm trading bullish order flow until, or I'll reference it here. So I'll touch on that in a second. So I'll continue to trust buy models until there's an obvious break in structure on the daily chart. So until structure is broken decisively and we see weakness, I'm not looking for bearishness in indices. And again, I'm not trying to call it top because order flow is still bullish. So what I'm watching here on the daily chart is this down close here, which is a propulsion block. We traded down into that last week, formed a swing low inside of this key level, and now we're expanding higher. So what I want to see is, can we get back above this daily fair value gap, use it as support, get up into that weekly rejection block, the weekly premium wick consequent encroachment, and then again, how we traded all those key levels will tell me whether or not we're going to challenge the all-time highs. Yeah, let me get back to your question, Julio. So the bearish one, no worries, man. Get your question in there. The chat will keep them there, so I'll be able to refer to them after. So the bearish order block here, absolutely. So that is a level you could have labeled with regard to the low, the open, and then 50% or the mean threshold. If you look at those levels, you're going to see they actually overlap with the weekly fair value gap here that I have. So for me to keep it more clean, I'm just working with the fair value gap, but it wouldn't be wrong to use this weekly up close candle and use that to study order flow, measure order flow, and see if we continue higher, and use those data points for confirmation. So absolutely, that would be a good consideration to have. The only reason I'm not is because I'm more focused on keeping my chart clean, efficient, easy for me to read, and obviously easy for you guys. So that's why I'm just electing to use the fair value gap. But absolutely would not be wrong to use the up close candle as well. But I noticed, and I know many of you guys and a lot of people I've coached struggle with, okay, now I put on the fair value gap. Okay, I see that level. Now I put on the order block, and I put on the wick, and then now we have, 20, 30 levels that then just makes it really hard to look at the price action, come across with a clear, easy to read narrative. So that's why every day when we're doing pre-market analysis in the live streams, that's why I go through these repetitions so that you guys can see how I'm getting key levels from the daily, weekly, and then how I use them intraday. And one of the biggest things that I've had to learn is how to keep it simple and streamlined so that you can actually use the insights, because I'm sure you guys have gone through the same thing. We learn a lot. We have a lot of levels, and we have 50 levels on the chart. It's like, now, oh shit, what do I do with all this? So that's some techniques that I use to keep it more streamlined and simple for what it is that I'm looking for. Dang, just noticed. Yeah, glad to cover it, Julio. Great question, my man, and good question for everybody else. All right, so daily time frame, again, down close candles continue supporting price. Order flows bullish, not standing in front of that until we get a decisive break in structure. All right, hourly time frame. So the hourly time frame remains in a consolidation profile, emphasizing the need to manage expectations and focus on intraday trades until the market leaves this range. I favor the buy side if we're to expand out of this range. So I want to give you guys a direction, right? I just don't want you to leave this thing, okay, well, Dylan said we're in a consolidation, it's 50-50. I favor the buy side. Why? Because top down, it's bullish, monthly, weekly, daily. So I favor these smooth highs, these buy stops up here being traded into, especially considering that these lows here traded down into those lows, upset that liquidity, and now we've seen an expansion from these lows here. So with that in mind, I favor a run on the highs, but as of right now, the market is in a consolidation profile, emphasizing the need to manage expectations until we leave this range. And you guys just saw a perfect example of that actually yesterday when I was covering the trade that I took live on Friday, and I was reviewing that with the model I taught. Even in this shitty price action here on an hourly time frame, that model still forms because it's just taking advantage of intraday runs to liquidity, which happen every single day, even in the worst trading days. So again, if you understand how to go in, find setups, pick your shots, you can still find fresh bread in consolidation. However, you do have to keep in mind that the market's much more likely to reverse on you quickly. You don't want to marry the vein and then hold for a huge run, especially in a consolidation. So again, emphasizing managing expectations until the range is left. But again, not to say it can't be traded, because it absolutely can if you know what you're looking for. So again, just emphasizing that I favor the buy side because top down, we're bullish. And then just wanted to note this in here for you guys. I know many of you guys actually screenshot this and use it throughout the week. So we could potentially see more difficult price action until after the US election. So there's a lot of uncertainty, a lot of things that investors, large funds, large pockets are having to weigh out. And many times they'll wait for after whatever the big event is to then look to get positioned. So if we see that, and we're seeing that the election's coming up, that could potentially influence the price delivery and make it more difficult to trade until after the US election. So keep in mind, we're in a consolidation, but keep in mind where we're at in the grand scheme of things. We have an election coming up in a couple weeks, a lot of things being thrown at this market from, the wars in the Middle East, and just everything going on right now. So you absolutely want to be mindful of the climate that we're in and everything that is being thrown at these markets. All right, so with that, that's the business there. Let me get the TradingView. All right, so let me see if you guys have any questions. Stay here for a few minutes with you guys until I got to get going. Yeah, great question, Julio. Unicorn Queen, I have a question from yesterday, Dylan. When you say risk 0.5%, are you speaking like 0.5% of the 50K account or 0.5% of the daily max drawdown? Really, really good question. And then as my man Matthew already said, trading prop and live accounts regarding risk management is different. Absolutely. So as far as, and I know I usually always give you guys the same answer whenever I'm asked about risk management, money management. I always say I never answer that, but I do my best to give you the information and the tools I wish I would have had so that I would have appropriate risk management. So I'll never tell you risk this much, but again, I will tell you what you need to do to come to the conclusion of what you should potentially do for your risk management. The biggest thing is going to be your experience. Can I risk 0.5% of a 50K, in your case, 50K funded account? Yes, because that would be 250 of risk, which would give 8 trades until I guess that account would be technically blown, considering it's a funded account. That all depends on where you're at in your experience level. If risking 250 of a $2,000 drawdown is way too much, then that's something that would have to be taken into consideration. For me, risking 0.5% on a 50K account is nothing because, okay, I take a hit. All right, I'm reducing my risk on the next one and I'm risking 125, 200. And then once I make that back, then I'm back to my original leverage. So as long as the risk is being managed, the account's not going to get blown. But it all depends on where you're at in your experience level. Because if you're just looking at it like, okay, I have $2,000, but now I just lost $250. Now that's over 10% of your account that you just lost if you're just looking at the $2,000 equity drawdown that you have. So maybe that's way too much risk for you because, man, that's 10% of all I have in the account. Well, then that may be something that's way too much risk for you. And you may want to just do 0.5% or 1% of the actual balance itself. So risking 1 to 2% or 0.5% with $2,000, what would that end up being? Yeah, like you'd have to be trading micros. So it all depends on the experience level. In my mind, trading 0.5% risk on the total 50K balance isn't too much if your experience level's there. If your experience level isn't there, then I would absolutely recommend going into micros. If you're starting, if you're just getting consistency, trading micros and trading low risk on those 50K accounts or 100K, whichever one you're starting on, would definitely be my recommendation. Because what you're going to do is you're going to build good habits. You're not going to be stressed out from each transaction to transaction, and you're just going to follow your model, follow the trading plan. And then over time, you're going to desensitize yourself to winning and losing. You're going to see, oh, okay, look, I had a losing week, but it's not the end of the world because I managed my risk and now I can come back next week and easily make that back. And it's only until that we've done those repetitions, we've walked it forward, we've made money, we lost money, and we just get comfortable with it, that then you can scale. So you trade one micro for some time and you realize, you know what? A losing trade isn't the end of the world. A losing week, a losing day isn't the end of the world. And then how we come back from that, and over time of getting those reps, you're gonna see, oh, drawdown's no big deal. So then when you start trading 2 micros, 3 micros, more contracts, and eventually 1 mini, you're gonna be carrying all the good habits that you've built from trading low leverage. And that's the right way to learn it, because unfortunately many folks just try to say, well, I wanna make the most amount of money possible. Well, you also have to be able to handle the psychological weight that managing big money is gonna put on you. And if you're not ready for it, it's absolutely gonna crush you psychologically and mentally. And the way you avoid that is by starting with low size. So hopefully that helps you out there with regard to framing that risk, because I know with especially the futures prop firms, it's very low risk threshold that you have. So there's a lot of considerations that have to be had for that. Silver Bullet Trader, good evening. Good evening. And quick question from yesterday, Dylan. As you said, use 9:30 open and 1:30 for New York and AM liquidity. Should I use 2 a.m. for London session liquidity or 3 a.m.? So for London session, pull up the London session. And again, another thing it's going to depend on as well as if it's a trending consolidation day, lots of factors there. So what I would use for London session, let me drop down to a 5-minute time frame, go to, yeah. So I'm trying to think of an example, but now that I look at it, it's a consolidation week, so it's going to be hard to get the examples that I was thinking of. I thought I had one off the top of my mind, but I actually don't. So for London session, I would use the 1:30 and then 2 a.m. opening price. So 2 a.m. opening price, that's when the algorithm will start to run for liquidity. And then with what we understand about the London session is this model actually works particularly well in the London session, because what is London session characteristic? False breakouts. So if this model takes advantage of running the liquidity and then repricing to the opposing intraday liquidity, London session is a great time to be capitalizing on that model because of what it's doing at that time of day. And it's not to say at the other times of the day, the market's still running for liquidity as well. So nothing changes. It's doing the same thing at all times of the day. But especially in the London session, using that 2 to 5 a.m. window and then looking for those false breakout characteristics, that's what I would look for there. And then I would start at 2 a.m. for the London session. And then there's other things that could be considered, like, for example, and this just makes it a little more advanced. So that's why it was a more simplistic model. But if you understand things like the opening range, which is 9:30 to 10, that's the opening range. for the PM session, 1:30 to 2 o'clock is the opening range. Well, for London session, 12 to 12:30 is the opening range. And that gives you insight you can use. But just to keep it simplistic within the model, 2 a.m., observe the liquidity that's formed before that on a 5 1-minute chart. And then from there, you can start to pick apart the model and get what it is that you're looking for. Awesome question, Ann. And thanks for the brilliant webinar. My absolute pleasure. Appreciate you joining, and I'm glad it was helpful. Alez, what days do you normally trade live in your community? Most days, probably 3 to 4 days a week, depending on the economic calendar and my schedule, of course, but definitely most days out of the week I'm live. Julio, has the webinar yesterday been recorded for members? Yes, sir. So I know the webinar was done free on YouTube, but what I will do is I'm going to upload it in the masterclass section. So I'll have my team get that taken care of. So where the masterclass section is, where you guys have all the videos to refer to in the community that myself and my team produce, you guys will have that in the masterclass section. So I'll make sure that's uploaded for you guys to review at your convenience. So you guys can go ahead and get that checked out, get the insights that you need, and it's a good one. So even for those of you guys that have been with me for the entire year, being trained and mentored, that's even a good one that I would definitely recommend you guys checking out. Don't think just because it was for free, I held back. You guys know how it is. If I'm putting the time into something, I'm gonna do it the right way. So I don't want you guys to think that, oh, I'm in the paid community and I'm getting the best stuff, because you guys know if I'm doing something, I'm gonna make sure it's all the best. So I definitely recommend you guys all checking that out. Unicorn Queen, okay, thanks. I trade micros and I usually divide my daily max drawdown in about 4 or 5 because I shouldn't lose that many trades in a row. Yeah, that's a great plan. And I think with the way you have that structured, trading micros, managing the risk, making sure that you're not getting into too many consecutive losses, I think you have a solid risk management and plan to keep going forward. And then now from there, you'll be able to collect data, see what needs to be improved, what areas don't need to be improved. And from there, you'll be able to move forward and make sure that that strategy works for you and is producing the results that you want from it. Well, as micros are awesome, you can partials and pyramid. Absolutely. Absolutely. Daniel, can you talk a little on trading idea being invalidated on low time frames, even though you have a bias on the higher time frame and not mirroring the trade idea? That's a really good question, Daniel. And that's a question I could be answering here for an hour or two. But the key with invalidating the lower time frames is understanding institutional order flow. There's lots of days I go into the market and I'm looking for something, but institutional order flow tells me that it's not going to do that. So I have 1 of 2 options: either just stand out of the way or switch my expectations to what the market's showing. So the key is going to be understanding institutional order flow. And now that I have that question, I'm thinking I'd want to refer you to a video on institutional order flow, but I actually haven't made one. So if I haven't made one, I should probably create it. So here's what I'll look to do. I'll look to do a YouTube video for you guys on institutional order flow, how I look at it, what are factors that I'm confirming, because that's a really good question. I give you guys the bias, I give you guys what I'm looking for, but you guys know not every day we're buying or not every day we're selling. So how do you know when to pivot? How do you know when to switch the bias? How do you know when to, okay, I thought it was going higher, but now it's indicating it's going lower? And what factors allow us to determine that, obviously, before it's too late? And that is really just a detailed understanding into institutional order flow. Because let me paint a picture for you. Let's say I'm bullish, I'm looking for higher prices on a particular day. Well, what would I want to see? Everything I touch on institutional order flow here with you guys, right? Down close candles should support price, imbalances should support price, and lots of other key levels that, like I said, I could explain, but in a basic way, that's what we're looking for. And then if I start to see that shifting, like on a 15, 5, and 1 minute, and we start to see that order flow shifting to the downside, and we don't see down close candles supporting price, we see lows being displaced through, we see aggressive expansion through all levels that should act as support, then that is the clearest indication that it's probably not going to go in line with your direction. That doesn't do it as much justice, but when you're looking at it over live price action, you're watching institutional order flow yourself, you'll see exactly what I'm saying. And over time, you'll be able to get the reps for understanding how to shift, how to pivot, and how to be flexible. Elkins, what's a good account percent gain to aim for each week, month? So again, all depends on experience level. I would say if you're starting out and you're in your first year, if you're aiming for 1 to 3% a month, that is phenomenal. So if you're in your first 6 months a year, 1 to 3% a month is great. Because if you can do 1 to 3% a month in your first year of trading and just aim for that, that's going to give you consistency and a foundation. So that now as you go into that second year, that third year, then you can start to aim for 3 to 6% a month. And then all you're essentially doing is scaling. So if you're doing 1 to 3% a month with 5 micros, let's say, well, what happens once you do that for 3 to 6 months? And now that 5 micros, you're very comfortable in that. Now you trade 10 micros or 1 mini. And now that 1 to 3% a month, you're now doubling that output, but with the same amount of work. So that's how you can scale. And then what happens when you go from 1 mini to 2 minis? And now you're doing instead of 3 to 6% a month, you're doing 6 to 12% a month. Right? And then from there you can scale, and it can be taken to very high levels without doing more work. So I would always recommend for a newer trader, aim for 1.5% a week. 1.5% a week puts you at 6% a month. And as long as you're hitting anywhere from 3 to 6% a month, you're doing numbers. And sometimes I get a question of, following that, well, 3 to 6%, that's not a lot of money. You're right, because it's not money, it's a percentage. That can all be scaled. Right? So if you're doing 3 to 6% a month on one funded account, like that's 50K, okay, I can appreciate that's not a whole lot. But what happens when you do that 3 to 6% a month and then you max out funding with TopStep, or you max out funding with Apex or My Funded Futures? And not that I'm recommending any of them, but I'm just saying, now that 3 to 6% a month, that doesn't seem like a whole lot. Now you can see that once you scale and you're doing that across several accounts, that's a shitload of money, right? So it's a lot of opportunity, but the key is just to focus on the consistency. Because if you can hit 1 to 3% a month or 3 to 6% a month, then from there, it's really easy to scale to lots of money. And that's usually where a lot of folks get it wrong on the money management side, because we want to scale into a lot of money, but we haven't established a foundation. We haven't established consistency yet. So what we have to do is get consistent with the least. And then from there, we can scale and build on top of that. Great question, Elkins. And brilliant. Thanks so much, Dylan. My absolute pleasure. Appreciate you. Silver Bullet Trader, loved yesterday's recordings. Awesome. Really glad you guys enjoyed it. Myself, my team put in the work for that one. And I'm glad it was delivering value. And I look forward to hearing how you guys do with it, how you guys start applying it, studying it. And I'm not encouraging anyone to go out and start over leveraging it next week, right? Study it, get a feel for it. And then over time, you'll get the confidence to start really banking with the strategy that forms every week. Eslam, what do you usually do when you can't read the daily bias or cannot get to where price is likely going? That happens, right? There's days where I sit down at my charts and I know exactly what the daily chart's likely to do. I frame it, it's easy, and it just happens. But there's days where that's not as clear. And then what I have to do is then, instead of the daily chart as my higher time frame, I use the hourly chart as my higher time frame, because you can trade an hourly time frame like a daily chart. You can trade a 15-minute time frame like a daily chart. So the way you're probably thinking of it right now is, okay, the daily chart's the higher time frame, then you have the hourly, the 15, and the 1-minute execution time frame. Well, what's the fractal understanding of that? Well, imagine now the hourly chart is your daily. The 15-minute is going to be your intermediate term time frame, and then you're executing on a 1-minute or seconds chart. So if I don't have clarity on the daily, then I zoom in. Now, what's the hourly telling me? Okay, maybe the hourly is not clear. Like, for example, on Friday, absolute shit show here. Nothing clear on the hourly chart for me. So what do I have to do? I have to go into the 15-minute. And then from here, I'm able to pick apart liquidity pools. I'm able to see, okay, there's a swing low. Here's a swing high. And then I map out my liquidity on the 15-minute. So it's all about refining. So if the daily isn't clear, okay, go to the hourly chart, refine it. If that's not clear, then go down to the 15. If that's not clear, well, usually if the 15 is not clear, then it's usually just going to be a really shitty day. I'd recommend avoiding it. However, if you can pick apart like what the 5 minutes doing, 1 minute's doing, and then you can find that narrative, then that will help you frame setups and price runs even when that daily or weekly chart may not be as clear. Julio, thanks AT fam. Appreciate you, brother. Great webinar yesterday. Amazing ICT trader. Really appreciate you guys. Thank you very much. José, gracias maestro por tu tiempo y conocimiento. Me perdí ningún directo porque estos directos valen oro. Que Dios te bendiga. Muchas gracias, hermano. I was just going to ask if you had a video on institutional order flow. I don't. I will absolutely have to make one because that is a popular topic. And now that I'm getting settled in, got moved out, getting settled into the new place here, I will be looking to get in more on the YouTube side of things. So be on the lookout for that. New resources that I'll be making available on YouTube, institutional order flow, other teachings. And you guys just gave me a good idea here on this one. So I'll have some good content coming out for you guys on institutional order flow. I'll give you guys even my full protocol on trading the AM and the PM session. I'll also have to schedule that in and get in touch with my team so we can go ahead and get that worked out. Tyler, process greater than profits. Absolutely. Absolutely. Looking forward to starting my first combine in a year after learning through your mentorship. Man, really excited to see it, Tyler, because I know that's been something that we've been looking forward to. And it's really hard to focus on the first 6 months, first 8 months of the year on tape reading, demo trading, building the right habits. But now as you transition into demo trade or into live trading, after having gotten in the reps, building the right habits, you're setting yourself up for success. Because this is a conversation I've had actually with many I've coached. Is that okay? Let's say you get a combine and you pass that combine, but you do it with all the improper habits. Well, then what happens is now you just have 5 express funded accounts or 5 funded accounts with whatever company you're doing, and you're going to have all the wrong habits. So what is that going to lead to? Blown accounts. So yeah, you may have got the certificate, but now what are we doing with that certificate? But if you build the right habits and you get the funded accounts with the right habits, then when you actually get to being funded, you're going to be able to keep it. You're going to be able to harvest consistent income from it because you've got there with the right habits. So huge point. Really appreciate you bringing that up, my man, and emphasizing that here to the whole community. Eslam, thanks for the answer, Dylan. Absolutely. Absolutely. Dennis, thank you for using your time to teach good trading habits. What is the best time frame to utilize trend lines? So really glad that the points that I touch on with regard to good habits, risk management, money management, that's being emphasized, and that you guys are taking that in, because like I said, those were things that I needed to hear early on that I had no understanding of. And it pushed back my learning curve months and years to when I should have got there because I was just getting improper guidance. So the fact that that's hitting home and it's helping you guys is awesome to hear. Then to answer your last question about what is the best time frame to utilize trend lines, none of them. I would, if I was being sincere and wanting to guide you with where you should go, I would not use trend lines at all. Trying to think how does I want to explain this. With what it is that we look at with the price action, understanding that it's algorithmic, it's running the key levels, it has no basis of understanding trend lines. Trend lines are actually attacked in the market. So what you want to look for and potentially maybe shift your focus towards is understanding liquidity, how the market runs the highs and lows, how it runs the inefficiencies. And in my opinion, that is going to be much more fruitful than trend line analysis. But if you're already using trend lines, making money, don't let me take you away from what you're doing. But if you are starting out and you're not sure with where to get started, which is what I'm getting from the question, I would recommend stay away from trend lines, understand liquidity, inefficiency, and time of day. And that's the best place for a new trader to get started. Unicorn Queen, thanks, Dylan, as always. So very helpful. Really appreciate that. Add DAX. Yeah, maybe I have to add the DAX in the next one. Hey, Dylan, great lesson yesterday. Terrific interpretation of price action. How can I approach / learn your approach with your trading team and mentorship? So as I was saying yesterday, really glad it was helpful. Really appreciate the feedback. You can schedule a free consultation to speak with me and my team, see where you're at, what your trading goals are, and what you may need to get you to where it is that you're looking to take your trading. And that may be with my team, it may be without my team, but regardless, you'll leave the consultation at least knowing what you have to do and how to get there. And it may not be with my team. Maybe you're not going to qualify for what we offer. Maybe you will. We'll be able to work together and get you there. And that'll all be able to be discussed on a consultation call, which should be found on the website. There should be a link. I think my team will be able to get it out to you. And you should be able to click that link, book a time, and we'll be able to discuss and get to work. Yeah, great question, Roberto. And again, really appreciate the feedback. All right, guys, that's going to be it for me. I'm going to get going. I got some things to attend to here today on this Sunday. I appreciate you guys joining us. Hope this one was insightful. And I hope you guys have a phenomenal rest of your weekend, guys. Take care, and I'll see you guys on the next one.